Most traders enter the market with a dangerous belief. They just need the right strategy. The truth is far more uncomfortable than that, because the market was never designed to reward your strategy. It was designed to expose your psychology. Let that sink in. You are not trading charts. You are trading yourself. And the moment you understand this, your entire perception of trading will collapse and rebuild again from zero. When I first started trading, I believed success was a technical problem. If I could just find better indicators, learn price action, master entry timing, then I would finally become profitable. For a while, I thought I was improving, but in reality, it was just changing tools while keeping the same mindset. And the mindset was the real problem, because every time I entered a trade, I was not neutral. I was attached to being right, making money, avoiding loss, proving myself. And attachment is the silent killer of consistency. You don't notice it at first, because sometimes you win, and those wins create a dangerous illusion. See, I know what I'm doing, but in trading, a win does not prove correctness, and a loss does not prove failure. They are both just outcomes of probability, nothing more. But the human mind refuses to accept that. It wants meaning, it wants control, it wants certainty, and the market gives none of that. That's where most traders break psychologically, not because they don't know enough, but because they cannot tolerate uncertainty. Mark Douglas explained this clearly. The market is a random distribution of wins and losses. Your edge only plays out over a series of trades, not a single moment. Traders don't think in series. They think in individual trades. This one must work. And that belief destroys them. Because the moment you expect a trade to work, you are no longer thinking in probability. You are thinking in certainty. And certainty does not exist here. Let's go deeper. Every trader starts with the same hidden enemy, their need to be right. First, it feels harmless. But in the market, being right becomes emotional addiction, because every winning trade gives you a dopamine hit, I was correct. And every losing trade feels like, I failed. So slowly, your identity becomes tied to outcomes. And once identity is involved, you stop trading the market. You start defending yourself from it. This is where everything becomes dangerous. Because now, a loss is not just a loss. It is personal. It is emotional. It demands correction. And that is when revenge trading begins. Not because the market changed, but because your emotional state did. You enter a loss. You feel discomfort. And the mind immediately demands relief. Take another trade. Fix it. Recover it. Prove it. But recovery trading is not strategy. It is emotional escape. And emotional escape destroys discipline. Here is the deeper truth most traders never realize. The market is not trying to hurt you. It is simply doing what it always does. Moving randomly within structure, expanding and contracting probability, creating uncertainty, but your mind turns that randomness into meaning. Meaning creates emotional reactions. That is the real battlefield, not charts, but interpretation. Two traders see the same setup. One sees opportunity, the other sees danger. Why? Because the chart is neutral. The mind is not. Your internal state determines what you see. That is why a perfect strategy can fail in the wrong mindset, and a simple strategy can succeed in the right mindset. Because execution is psychological, not technical. Let me say it clearly. Your biggest trading problem is not entry. It is emotional inconsistency during execution. You can have the best system in the world, but if your mind is unstable, you will exit early. You will enter late. You will break rules. You will hesitate. You will overtrade. And slowly, your edge disappears. Not in the market, but in your behavior. Now pause here, because this is the turning point most traders never reach. You don't need a better system. You need a stable mind executing a simple system consistently. Here is the problem. Stability does not feel exciting. Traders confuse excitement with progress, so they keep searching. New indicators, new strategies, new confirmations. Every new tool is just a distraction from the real work. Mastering your emotional response to uncertainty. Until that is solved, nothing else matters. Not strategy, not analysis, not setup quality. Because the same trader will keep producing the same result in different forms. Now you are about to see something deeper. Because once you stop blaming strategy, you are forced to face something uncomfortable. Yourself. Because the real question is not, what is the best strategy? The real question is, why do you consistently break your own rules, even when you already know them? Patience, boring success, and emotional discipline under stillness. Something unexpected happens. Something unexpected happens. So you are no longer struggling with losses. You are no longer forcing trades. You are no longer chasing the market. And yet, something still feels uncomfortable. Because now the problem is not pain. It is stillness with awareness. This is where most traders think they have improved, but internally they are facing a new psychological test. Can you stay disciplined when nothing is wrong? Let that sink in, because when traders stop overtrading, they assume they have reached stability. Stability is not comfort. Stability is silence. And silence exposes everything inside you. How boredom returns. This time it is different. It is not frustration-driven boredom. It is success-driven boredom. And this is far more dangerous. Because when trading is not going wrong, the mind starts asking, if everything is fine, why am I not doing anything? And this question feels logical. But it is not. It is emotional discomfort disguised as reasoning. Now let's go deeper. When the market slows down or gives no setup, the trader sits. And in that silence, thoughts start to appear. Maybe I'm missing something. Maybe I should just take a small trade. One setup won't hurt. I'm being too strict. And slowly, discipline starts getting negotiated. Not broken immediately. Negotiated. And that is how trading accounts are slowly destroyed. Not through big emotional explosions, but through small compromises. Now here is the truth. Most traders never accept. Success does not end discipline problems. It exposes new ones. Because now you are not reacting to loss anymore. You are reacting to inactivity. And inactivity feels like inefficiency. But in trading, inefficiency is often correct behavior. Because the market does not offer opportunity continuously. It offers it in phases. Professionals understand this deeply. They do not trade more when they are bored. They wait more. Beginners interpret waiting differently. They think, if I'm not trading, I'm not progressing. And that belief is extremely costly because it turns patience into pressure. Now let's go deeper. At this stage, discipline is no longer tested during volatility. It is tested during calmness. Because calm markets create psychological temptation. No harm in taking just one trade, but just one trade is where deviation begins. And deviation compounds silently. Now here is the core psychological shift. A trader must stop measuring success by activity and start measuring it by restraint. Because restraint means, I had the urge, but I did not act on it. That is real control, not execution. But non-execution when execution is unnecessary. Now let's connect to Mark Douglas's principle. Consistency is not about being right. It is about executing your edge without deviation over time. And deviation often starts when nothing is happening. Because the mind cannot tolerate emptiness. So it fills it with trades, with ideas, with assumptions. But none of that is edge-based. It is emotion-based. Now here is the deeper truth. Stillness in trading is not passive. It is active discipline. It is decision-making through non-action. And that requires more mental strength than execution itself. Because execution gives dopamine, waiting gives nothing, and the brain struggles with nothing. So traders try to create meaning. If I'm not trading, I'm wasting time. But time is not wasted in waiting. Time is preserved capital. Because unnecessary trades do not just lose money, they destroy clarity. Now let's go deeper psychologically. After a period of success, traders feel something subtle. I have figured this out. And that belief creates reduced vigilance. Because when you think you understand something, you stop respecting it. And that is when small errors begin. Slightly earlier entries, slightly looser rules, slightly bigger risk, slightly less patience. Nothing dramatic, just small shifts. But in trading, small shifts compound into large consequences. Now here is the paradox. The better you feel, the more dangerous deviation becomes. Because confidence reduces self-checking. And self-checking is what maintains discipline. Now let's bring clarity. A professional trader during success says, I must protect consistency now more than ever. An amateur trader during success says, I can relax now. And that difference defines long-term survival. Now here is the final insight of this part. Patience is not waiting for trades. Patience is waiting without needing validation from the market. Because the market does not exist to validate you. It exists to present opportunity when conditions align. Nothing more, nothing less. And once you truly accept that, something changes inside your trading psychology. You stop chasing movement. You stop reacting to boredom. You stop forcing participation. And you begin to understand something deeper. Not trading is also a position. And sometimes, it is the most profitable one. Because once you learn to stay still in success, new psychological challenge emerges. And you stay disciplined when success starts to change how you see yourself. Confidence, ego expansion, and the hidden collapse. At this stage of trading, something strange happens. Everything starts going right. Not perfectly, consistently enough to feel real. That is exactly where the danger begins. Because success does not warn you, it rewards you. Reward slowly changes behavior without permission. First, confidence feels like progress. You think, I'm finally becoming good at this. For the first time, trading feels under control. What is actually happening is deeper. You are not becoming more skilled. You are becoming more confident in recent outcomes. Those two are not the same thing. Now let's go deeper. When traders enter a winning phase, something subtle shifts inside. They stop following rules strictly, not because they forgot them, but because they start trusting themselves more than the system. That is the beginning of ego expansion. Now, ego in trading is not always loud. It does not always say, I am the best. Sometimes it says, I don't need to wait that long anymore. Or, I can take this, even if it's not perfect. Or, I understand how this market moves now. These thoughts feel harmless, even intelligent. They are actually deviations from structure. Now here is the psychological trap. Success removes fear. And fear, while uncomfortable, is actually protective. Fear makes you respect risk, follow rules, wait for confirmation, avoid overexposure. But when fear disappears, discipline starts to loosen quietly. And traders don't notice it, because results are still good. This is why ego expansion is silent. It doesn't feel like destruction. It feels like improvement. Now let's go deeper. After a winning streak, traders often begin to increase position size, take more setups, reduce patience, enter earlier, skip confirmations, and every decision feels justified by recent success. The market does not reward recent behavior. It rewards consistent behavior over time. And that difference is everything. Now here is the hidden problem. Ego does not destroy trading immediately. It removes structure gradually. One small rule broken becomes acceptable, then another, until rules are no longer rules, they become suggestions. And suggestion-based trading is not trading. It is emotional decision-making. Now let's break the illusion clearly. When you win, your brain releases dopamine. Dopamine reinforces behavior. So the brain starts thinking, this way of trading is correct, even if that way includes overconfidence, reduced discipline, increased risk, emotional shortcuts. Because the brain is not measuring quality, it is measuring reward. Reward feels like truth. Now here is the dangerous part. The trader begins to believe, I have figured out the market, but what they are actually experiencing is a favorable distribution phase. Not mastery, not control, not skill dominance, just probability working in their favor temporarily. But ego does not recognize probability. Ego recognizes identity. So now the trader says, I am a profitable trader, and that identity becomes fragile, because it depends on continuation of recent outcomes. Now the market shifts. It always does. And suddenly, setups stop working, losses return, entries fail, confidence breaks, and confusion begins. Because internally the trader thinks, this shouldn't be happening. But trading does not operate on should. It operates on uncertainty. Now ego reacts. And ego never accepts randomness. It searches for explanations. Market changed. Strategy is broken. Something is wrong externally. But the real issue is internal. Behavior drift during success. Now here is the most important insight. The most dangerous phase in trading is not loss. It is success without discipline. Because success removes self-correction. When you are losing, you review everything. But when you are winning, you assume everything is correct. And that assumption is where collapse begins. Now let's go deeper. Every small deviation during success feels harmless. One early entry, one bigger lot size, one skipped rule, one emotional trade. But these are not isolated events. They are the beginning of pattern distortion. And patterns define long-term results, not single trades. Now here is the psychological truth Mark Douglas emphasized. You are not trading the market. You are trading your belief about the market. And beliefs change faster during success than during failure. Because success feels like confirmation. But confirmation of what? Not necessarily skill, just temporary alignment with probability. Now let's reach the turning point. A professional trader does not increase freedom during success. They increase discipline because they understand something critical. Success is where most mistakes are born, not failure. So instead of relaxing rules, they tighten awareness. Instead of increasing risk, they stabilize execution. Instead of trusting emotion, they trust process. Now here is the final realization of this part. Ego does not appear when you are struggling. It appears when you are comfortable, because comfort reduces vigilance. Reduced vigilance allows deviation. Now the trader reaches a critical crossroads. Either they stay consistent and protect structure, or expand ego and slowly lose discipline, and both paths feel justified in the safe. Only one survives long-term uncertainty. Now the journey is almost complete. There is one final layer left. Because even when ego is controlled, discipline is restored, there is still one final test every trader must face. Not emotional extremes, something far more subtle. Because once ego is exposed, the final challenge begins. Can you remain disciplined when nothing in the market feels exciting anymore? Only probability remains mastery. Probability thinking and the final transformation. At the end of every trader's journey, there is no explosion, no dramatic moment, no sudden realization with emotion. Instead, there is silence, calm, almost boring acceptance of reality. That is the final stage of trading psychology. Not excitement, not confidence, but neutrality. Because at this level, the trader finally understands something fundamental. The market was never trying to hurt you. It was never trying to help you either. It was simply moving, randomly within structure, constantly shifting probability. Your job was never to predict it. Your job was to execute within it. Now let's go deeper. At this stage, the trader no longer asks, will this trade win? Because that question is meaningless. Instead, they ask, did I follow my edge correctly? That is the only question that matters. Because once you understand probability, you stop measuring individual outcomes. You start measuring consistency of execution. Now this is the Mark Douglas shift. One trade means nothing. 10 trades mean nothing. Even one losing week means nothing. 100 trades executed correctly means everything. Because only the series reveals truth, not the moment. Now, let's break the final illusion. Most traders believe success means high win rate, perfect timing, avoiding losses. But professionals know the truth. Success means consistent execution, controlled risk, emotional neutrality, acceptance of randomness. Nothing more, nothing less. Now let's talk about what mastery actually feels like. It does not feel powerful. It does not feel emotional. It feels simple, almost too simple, because all noise disappears. No fear after losses, no excitement after wins, no urgency after missed trades, no emotional attachment to outcomes. Just repetition, just execution, just probability. And that is why most traders never reach this stage, because simplicity feels like nothing is happening. But in reality, everything is under control. Now, here is the deepest truth in trading psychology. The market never changed. You did. At the beginning, you wanted certainty. In the middle, you wanted control. At the end, you accept uncertainty. And that acceptance is mastery. Because once uncertainty becomes normal, emotion loses authority over decisions. Now you no longer try to avoid losses. You no longer try to force wins. You simply execute your edge and allow probability to unfold. Now let's bring everything together. Every trader's journey is the same. Strategy illusion, emotional loss reaction, revenge, trading, overtrading, impatience, confidence expansion, ego distortion, breakdown of discipline, awareness phase, probability understanding, emotional neutrality, mastery, and finally, acceptance. Not acceptance of results, acceptance of randomness. Now here is the final realization. Professional trader is not someone who predicts correctly. Professional trader is someone who can execute consistently under uncertainty, remain disciplined during wins and losses, detach identity from outcomes, trust probability over emotion. That is real mastery. Now let's end this journey properly. Because the final truth is not about the market. It is about you. Market is simply a mirror. If you are emotional, it amplifies emotion. If you are disciplined, it reflects discipline. If you are inconsistent, It exposes inconsistency. It shows you exactly who you are, not who you think you are. And every trade is just feedback. Nothing more, nothing less. Now the final question is not, how do I win more trades? The final question is, who do I become when I face uncertainty repeatedly? Because once you answer that, you stop trying to control the market. You start controlling yourself. And that is the only real edge that ever existed. Because in the end, you don't master the market. You master your relationship with uncertainty. When that happens, market stops being your opponent and becomes your teacher.